It's 9:47 p.m. The Walgreens parking lot is half empty. One car is still running. Inside that car, there's a guy named Marcus. He's 31. Marketing job. Nothing flashy. No rich parents. No crypto luck. No startup exit. Just 6 straight years of doing boring, disciplined stuff. Bringing lunch to work. Driving a paid-off car. Living with roommates longer than his pride wanted. Saying, "I can't this weekend," more times than he can count. 3 weeks ago, he opened his banking app. And for the first time in his life, he saw a number that didn't feel real. $100,247. He refreshed the app, closed it, opened it again. Still there. He didn't celebrate, didn't text anyone, didn't smile. He just sat there. 11 minutes. Engine running. Heart racing. Because hitting $100,000 doesn't feel like winning. It feels like pressure. Now the money is big enough that every decision feels dangerous. One bad move, and 6 years of discipline disappears. And here's the part nobody warns you about. The first $100,000 isn't where people win. It's where most people quietly lose. Today, I'm going to show you exactly why, and how Marcus avoids becoming another statistic. Before $100,000, money feels heavy. Every dollar takes effort. Every save feels like sacrifice. After $100,000, something strange happens. The money starts pulling its own weight. Think about this. If Marcus invests $100,000 and earns around 8% per year, that's $8,000 a year in growth. That's over $650 a month. Showing up without him clocking in. No meetings. No commute. No boss. The money now has a job. And once your money has a job, your life trajectory changes. Your second $100,000 arrives faster than the first. Your third faster than the second. Not because you worked harder, but because compounding finally woke up. This is the tipping point. The moment the system starts working with you instead of against you. But most people sabotage this phase. Not with reckless mistakes. Marcus tells himself, "I worked too hard to lose this. I'll just keep it in savings." It feels responsible. It feels mature. Feels calm. But calm can be expensive. Most regular savings accounts barely keep up with inflation, which means every year, your money quietly buys less. Your balance looks the same. Your purchasing power shrinks. It's like storing ice in a warm room and pretending it's fine, because the shape still looks the same. Someone made money on crypto. Someone flipped a stock. Someone swears they figured out the market. So Marcus starts believing, if he studies hard enough, he can outsmart millions of investors. Here's the uncomfortable truth. Even professional fund managers, people with research teams, insider access, and fancy degrees, fail to beat simple index investing most of the time. The market doesn't reward brilliance. It rewards consistency. Trying to outplay the system is how normal people lose to their own emotions. With reasonable ones, it was almost 10 at night when Marcus finally sat in his car outside a nearly empty Walgreens parking lot. He wasn't tired from work. He wasn't scrolling his phone. He wasn't waiting on anyone. He had just opened his banking app and saw something he had never seen in his life before. A 6-figure balance. $100,000 and some change. He refreshed the screen because it didn't feel real. Then he refreshed it again. Still there. He didn't smile. He didn't text a friend. He didn't call his parents. He just sat there with the engine running, staring at the number, feeling something he didn't expect at all. Not pride. Not excitement. Pressure. Because now the money was big enough that every decision felt dangerous. Marcus is 31 years old. He makes a decent salary. Nothing flashy. No overnight success story. No lucky investment. Just 6 straight years of boring discipline. He packed lunches when coworkers ordered out. He drove a car that was paid off when everyone else upgraded. He lived with roommates longer than his ego wanted to admit was comfortable. He said no to trips, to nights out, to lifestyle upgrades that felt harmless in the moment but expensive over time. Every dollar he saved felt slow, heavy, manual. Hitting $100,000 didn't feel like winning. It felt like standing at the edge of something unfamiliar. Because before this number, money was something he chased. After this number, money became something he had to manage correctly or risk undoing years of effort. And here's the part nobody really talks about. The first $100,000 is not where people secure their future. It's where most people quietly ruin it without realizing they're doing anything wrong. Before this milestone, every dollar Marcus saved came directly from effort. More discipline meant more money. Less discipline meant less money. The relationship was simple. But once you cross into six figures, the relationship changes. Now the money itself starts working. If that $100,000 grows at a reasonable long-term rate, it begins producing thousands of dollars a year on its own. Not because Marcus worked harder, but because compounding finally has enough fuel to move. This is the point where wealth can begin to snowball. This is also the point where small, psychological mistakes start costing huge amounts of future money. Marcus doesn't know it yet, but the next 90 days after hitting this milestone matter more than the previous 6 years combined. Not because the choices are complicated, but because they feel emotionally loaded. Everyone around him has advice. A coworker is hyped about crypto. His dad talks about real estate because that's what worked for the generation before him. Social media is full of people claiming they cracked the code with individual stocks. And somewhere in Marcus's own head is a quiet voice telling him that after being so careful for so long, maybe he's earned the right to relax a little. That voice doesn't sound reckless. It sounds reasonable. It sounds human. And that's exactly why it's dangerous. This moment in the parking lot wasn't the end of Marcus's journey. It was the moment the rules changed. Before this, discipline was the main tool. After this, strategy becomes the deciding factor. The people who turn their first 100,000 into long-term wealth are not the ones who suddenly get smarter, luckier, or braver. They are the ones who understand that this number is not a finish line. It's the starting line of a different game. After that night in the parking lot, Marcus didn't suddenly become reckless. In fact, he became more cautious than ever. He kept checking his balance, almost like he was making sure the money didn't disappear while he wasn't looking. One part of him wanted to protect it at all costs. He told himself the safest move was to just leave it where it was. A regular savings account. The number looked stable. Nothing went down. Nothing dramatic happened. It felt calm. But calm can be misleading when it comes to money. While the balance stayed the same on the screen, the real value of that money was slowly shrinking in the background. Prices around him were rising. Rent was higher than it was a few years ago. Groceries cost more. Gas cost more. Everything quietly cost more. The money wasn't being protected. It was slowly losing its strength. Not in a way you can see day to day, but in a way that shows up years later. When you realize the same money buys you less of your own life. Then the other voice kicked in, the one that sounded ambitious. Marcus started paying attention to finance content. He heard stories of people who caught the right trend at the right time. He saw screenshots of huge returns. He listened to coworkers talk about the one trade that worked for them. It planted a dangerous idea in his head. Maybe now that he had real money, he could play the game at a higher level. Maybe with enough research, he could beat the system. The problem with this thinking is not that it's stupid. The problem is that it's emotional. The market doesn't reward effort the way jobs do. You can't work harder at investing and expect consistent rewards. You can only behave better. And most people don't. They chase what's already gone up. They panic when things drop. They hesitate when it's time to be patient. Over time, that emotional behavior quietly drags their results below what simple, boring investing would have delivered. The tragedy is that people often blame bad luck when the real, probably the third trap, didn't feel like a mistake at all. It felt like relief. Marcus had spent 6 years being careful. He had delayed comfort. He had made choices that weren't fun in the moment. And now, finally, there was breathing room. He didn't go on a wild spending spree. He didn't buy anything crazy. He just slowly started upgrading his life in ways that felt reasonable. A slightly nicer apartment. Eating out a bit more. Not tracking every dollar with the same intensity. Nothing dramatic. Nothing irresponsible. Just a gentle loosening of discipline. The problem with this kind of change is that it doesn't announce itself as a problem. It feels like balance. It feels like growth. Your brain tells you that you've arrived at a safer place and can relax a little. Over time, your new normal becomes more expensive, and the extra margin that used to go into investing quietly disappears. The money doesn't blow up. It just stops accelerating. Years later, people look at their accounts and feel confused about why their net worth barely moved compared to how hard they worked. Nothing went wrong in one big moment. Momentum was just slowly traded for comfort. If Marcus lets these 3 patterns run his next few years, his story doesn't collapse. It just stalls. He becomes someone who once hit 100,000 and then spent the next decade wondering why it never really turned into anything bigger. And this is where the story changes. Because avoiding these traps is only half the game. The real shift happens when Marcus sets up a system that grows without requiring him to constantly fight his own emotions. Was trying to outsmart something that doesn't care how smart you feel. Marcus realized that if he tried to rely on willpower alone, he would eventually lose. Discipline works when you're climbing toward a goal. It becomes fragile when you feel like you've arrived. So instead of making emotional decisions, he built a system that removed choice from the equation. The first part of that system was simple protection. Not all of his money should be exposed to the market at once. Life still happens. Cars break. Jobs change. Emergencies don't schedule themselves. So Marcus set aside a few months of living expenses in a place that was easy to access but not tempting to touch for everyday spending. This wasn't money meant to grow aggressively. It was money meant to protect his ability to stay invested when life tried to interrupt his plans. Once that buffer existed, the rest of his savings could be invested without fear. Fear is expensive in the market. It's what causes people to pull out at the worst times. The emergency fund wasn't about returns. It was about psychology. It allowed Marcus to leave his investments alone when the headlines turned. Scary because he knew his short-term life was covered. The next part of the system was capturing free money from his employer. Marcus had always contributed something to his retirement plan, but now he became intentional about making sure he never left. Matching dollars on the table. Every matched dollar was instant progress without extra effort. He treated that match like part of his paycheck that only existed if he claimed it. Over time, this alone quietly added tens of thousands of dollars to his long-term wealth without him feeling any additional pain in his day-to-day life. Then Marcus looked at his debt honestly instead of emotionally. Not all debt is the same. Some debt is a slow leak that drains future growth. Some debt is cheap enough that investing beats paying it down aggressively. He separated what was truly holding him back from what could be managed over time. This wasn't about feeling virtuous. It was about letting math guide the decision instead of fear. Once the high-interest stuff was handled, he stopped obsessing over low-interest balances and focused on growing his assets instead of just shrinking liabilities. With the foundation set, Marcus turned to the part most people overcomplicate: investing itself. He expected it to feel complex. It didn't. The more he learned, the more he realized that complexity mostly benefits the people selling it. He didn't need a dozen strategies or a constantly changing list of ideas. He needed exposure to the overall growth of the economy and the discipline to stay invested when emotions told him to do the opposite. He built a simple portfolio that owned a wide slice of the market instead of trying to guess which small piece would outperform next year. This approach didn't give him exciting stories to tell at parties. It gave him something better: predictable progress over long periods of time. He automated everything. Money moved into investments before it ever had the chance to become lifestyle spending. Raises didn't change his daily life as much as they changed his investing rate. Over time, this automation created a quiet separation between his income and his lifestyle. His life improved slowly and intentionally, but his investing grew aggressively in the background. This prevented the subtle lifestyle drift that kills momentum. The system didn't require constant motivation. It only required him to not interfere with it. Marcus also made peace with volatility. He stopped seeing market drops as threats and started seeing them as part of the cost of long-term growth. The price of higher returns is discomfort. Anyone who promises growth without discomfort is selling a fantasy. By expecting the swings, Marcus stopped reacting to them. He learned that the real risk wasn't temporary drops. The real risk was breaking the process. Because of fear during those drops 6 years ago, Marcus believed that building wealth meant grinding harder than everyone else. Saving felt like effort. Progress felt slow. Every dollar required a decision. Now the game is different. His money is no longer just a reflection of his discipline. It's an engine that grows whether he's thinking about it or not. The weird part about this phase is that it feels boring on the surface. No dramatic moves. No bold bets. No exciting stories. Just quiet consistency. But over time, the results become anything but boring. This is where most people misunderstand what easing off really means. It doesn't mean you stop caring. It doesn't mean you start spending everything you worked for. It means the exhausting phase of building from zero is over. The work now is psychological, not physical. The work is staying patient. The work is staying boring. The work is protecting the habits that got you here even when your bank balance starts to make you feel comfortable. The parking lot moment didn't mark the end of Marcus's journey. It marked the point where the story stopped being about survival and started being about trajectory. He doesn't need luck. He doesn't need genius. He doesn't need perfect timing. He just needs to stay in the game long enough for the math to do what the math has always done. If he does that, the first $100,000 won't be the most impressive number in his life. It will just be the moment everything quietly started to work in his favor. It took Marcus a few days after that parking lot moment to actually move the money anywhere. Not because he was lazy, but because he understood that the first moves after hitting a milestone often set the tone for everything that comes after. When you've spent years building toward a number, your brain treats that number like a finish line, even when logically you know it's just the beginning of a longer race. The danger isn't blowing the money. The danger is letting comfort replace momentum. Marcus decided that before he touched a single dollar for investing, he needed a layer of stability that would keep him from panicking the first time life threw him a curveball. He set aside enough cash to cover a few months of normal living expenses and put it somewhere that was easy to access but not sitting in the same account he used for daily spending. This way, if something unexpected happened, he wouldn't be forced to sell investments at a bad time just to handle a short-term problem. That one move alone changed how confident he felt about letting the rest of his money stay invested through normal ups and downs. Once that buffer existed, Marcus stopped thinking in terms of one big decision and started thinking in terms of systems. Systems don't rely on motivation. They don't care how inspired you feel on a random Tuesday. They run in the background. He set up automatic transfers that moved money into his investment accounts the same week his paycheck landed. The timing mattered. If money hits your checking account and sits there, it starts feeling spendable. If it moves out immediately, your lifestyle adjusts around what's left. This one detail quietly determines whether raises become future wealth or just slightly nicer habits. Over time, Marcus noticed something interesting. His lifestyle didn't shrink. It just grew slower than his income. The gap between what he earned and what he spent became the engine of his future net worth. Marcus also changed how he thought about risk. Before hitting six figures, risk felt like something to avoid. After hitting six figures, he realized that avoiding all risk was its own kind of risk. Money that never faces volatility also never gets the chance to grow meaningfully. The goal wasn't to chase wild returns. The goal was to accept the normal ups and downs that come with long-term investing, and not let temporary fear interrupt a long-term plan. He reminded himself that volatility isn't a signal that something is broken. It's the cost of admission to higher returns over decades. Once he reframed it this way, market swings stopped feeling personal. They became background noise instead of threats. As his confidence grew, Marcus noticed how different his relationship with money had become compared to his early 20s. Back then, every expense felt like it mattered in isolation. Buying a meal out felt like stealing from his future. Now he could see the bigger picture. Small decisions still mattered, but they mattered as part of a pattern, not as individual moments. This shift didn't make him careless. It made him strategic. He started asking better questions, not just about how to make more money, but about how to protect his ability to keep making good decisions. When things got boring or stressful, the real enemy wasn't ignorance anymore. It was complacency. The funny part about long-term wealth building is that it rarely feels dramatic while it's happening. There are no fireworks when your investments quietly compound. No applause when automated contributions go through on schedule. No recognition when you don't panic during a market drop. From the outside, it looks uneventful. From the inside, it requires a kind of patience that most people aren't taught. Marcus had to learn to sit with the discomfort of not doing something. During periods when the smartest move was simply to let the system run, he learned that the urge to constantly adjust, optimize, and react was usually just anxiety in disguise. Years from now, Marcus probably won't remember the exact balance he saw in that Walgreens parking lot. What he'll remember is the shift that happened in his head. The moment he stopped seeing money as something fragile that needed constant guarding and started seeing it as a tool that could quietly work for him if he built the right environment around it. The first $100,000 didn't change his life overnight, It changed the direction of his life slowly. The way a small turn of a steering wheel changes, where you end up hours down the road. If he stays boring, stays patient, and stays out of his own way, that quiet shift will end up mattering far more than any dramatic decision he could have made in that moment.